So welcome back to the Study Prep Guys channel, everyone. Today we're looking at accounting principles and concept. So let's look at what exactly is accounting, right? So there are several assumptions concerned with the record of transactions in the books. So the most important thing is that the financial statements, known as the financial accounts, must be drafted in the same way. This is so that there is a common format that all accounting users of information can understand. The following use of financial statements: a banker, investor, the owner to know his profit. An investor, this is someone who wishes to buy the business that you own, and a banker is to decide on whether the um to provide a company with a loan. So we have the tax department for tax purposes. And what does this all mean? In a simple sense, this simply means that the banker, the prospective buyer of the business, the owner, and the other persons or other people all see the same income statement, trading and profit and loss account and balance sheet. The following accounting principles are followed to provide consistent, usable financial statements. We have relevance. Financial information is considered relevant if it affects the business decisions. We have two, reliability. Information should be free from significant errors, bias, and independently verified. We have comparability also. This could be compared with other periods and similar businesses that usually undergoes in these business segments. We have understanding. This is the financial report or income statement, trading and profit and loss account, and balance sheet must be capable of being understood by users of the report. It must be so that everyone could understand what exactly is in this. It could show a clear line of either surplus or deficits. And for those of you who do not, I'll just use it in this context of principle of accounts. It shows the amount of money you're gaining via to the amount of money that you're losing. So let's look at the accounting concepts now. So the accounting concept are the rules that are applied in recording transactions and preparing the trading and profit and loss account and the balance sheet. So we have the business entity concept. This rule states that only the transactions of the business should be recorded and not the owner's private transactions. Example, the owner buys himself grocery will not be recorded. So this is the business entity concept. So the business acting as a separate entity. And we did make a video on this concept a little bit. We did touch on it a little bit on the last video on the principle of business play sheets. You could look at that in the channel below. In my channel below, you have a playlist on the principle of business, everything you need to know for business per CSEC. So you could look at that. So secondly, we have the money measurement concept. Only transactions that can be expressed in monetary terms are to be recorded. Example, the motivational level and skills of the employees will not be recorded. So the motivational levels mean how enthusiastic they are. That will not be recorded. So the skills of the employee will not be recorded. Also, it for example, we have charter. If you do an hour of work, you will get paid according to that hour of work. Your motivational levels or the amount of work you're getting done within that hours is irrelevant in any santical manners. And then we have the third concept, which is the historical cost concept. All transactions are recorded at their cost of the business. For example, a machine bought for a bargain at 50% less than what it is worth will still be recorded at the cost paid and not at the higher value it may be worth. So they will only look at it from the 50% and not at the 100%. So that is what that simply means. We have the realization concept. Profits are realized, actually earned when cash or a debtor replaces the goods or services. A transaction is not realized when an order is received or when a debtor pays his debt. So when a debtor pays his debt, that is not a realized gain because you're just earning what is already stated. So it's only a case when a debtor replaces the goods or services or or when cash is actually received in hand. Because if you're paying back for something that you literally already owe, it is not regarded as a gain. It is not regarded as a profit. So it is not actually realized. So we have the fifth concept, which is a dual aspect concept or duality. Every transaction will affect two items in the business. This is represented by both a debit and a credit entry in the ledger. Example of this is a transaction is considered to have a given and taken effect So the purchase of stock for cash will reduce cash amount in the balance sheet and increase the stock of goods. We have then sixth, we have the consistency concept. Transactions of a similar nature should always be recorded in the same or consistent way. This is to ensure that the profit and loss account and balance sheets can be meaningfully compared each year. So we need to see a consistent thing of profits. So this is usually done through the profit and loss accounts and balance sheets. We will look into the balance sheets and stuff in these later videos, but I'm just giving you an introductory concept into what it actually is. So, example, keeping a percentage rate of depreciation the same every year. For example, if you have a 2% depreciation on a particular good, or if we're selling machinery, what depreciation actually is, it's the devaluation of a good as the years goes on. For example, if you buy a Nissan or a Ford Ranger vehicle in the year 2014, in the year 2025, the value of that good will depreciate, it will change, it will be for less in the year 2028 or 2030. That's what depreciation actually is. And after that, we have the seventh concept, which is the materiality concept. This concept implies that you should not waste time recording transactions that are trivial, involving very small amounts of money. So be careful what is trivial to a large means. This could be material to a small business. So there's a very much differentiation right there. So example of this: depreciation in a cheap waste paper bin, paper clips left over at the end of the year to be used for the following year. So small items should really not be like depreciated. But in the case of a small business, that could be relatively different. For example, in the case of like a clip, or a hair clip or some kind of clip, you could, or book clip, a pin or something. um, those depreciation could be essential. Well, there's a very much differentiality between these two when it comes back down to this concept entirely. Let's look at the accruals or the matching concept. The trading and profit and loss account should only include the income earned and expenses incurred for the current financial year. Example of this: rent still owing at the end of the year should be included in this year's expenses. So it should match. So rent still owing at the end of the year should be included in the this year's expenses. So if you owe for like a if you owe, like, for example, if you bought stocks on credit, and then you mean you bought stocks on credit, you did not actually pay for it as yet, and that amount of stocks you bought on credit is 5,000 for the year 2023, you should include it in the year 2024. So and for the ninth concept, we have the prudence concept. This concept states that profits must be overstated and the value of assets must not be shown to be too high. The account's duty is to ensure that the readers of the financial accounts get a true and proper picture of the financial state of the business. Example, write off a bad debt even though there is a small chance that the debtor may still pay. So the prudence concept is that in general. So let's look at the going concern concept now. It is now assumed that it is consumed that assume that a business will not continue to exist for a long period of time. So this deals with continuity, right? So an example of this is on the last day of the financial year, the government passed a law which prevents us from selling our product. We should still continue to drop the financial accounts in that case scenario. We should look at alternatives to if that happens. We should look to sell new products, or if the owner of a business is about to die presumptuously. This is a very large take, but we should still consider the fact of actually getting someone to actually replace and to fill in that position. So let's look at the substance over form. The practical view, the substance is preferred to the legal view, of form in accounting. Example: a machine bought on hire purchase remains the possession of the seller until the last payment is made. Legal or form view. From an economical accounting view, the machine is used in the business and so will be shown on the balance sheet as a fixed asset of the business, substance. So that's what the substance over form means in general. So that is everything for introduction to accounting, guys. See you on the next video. Subscribe, hit the notification bell, and we'll be looking into different content concepts on this playlist. See you guys on the later video.